Hi there, my name's Tim Hext and I'm a portfolio manager in the bond, income and defensive strategies team at Pendal Group. Well, in terms of crystal ball gazing, of course, you need to be a very informed medical scientist to know where this is all going. And to be totally honest, we don't know. We're quite hopeful that you will see some antiviral drugs help the situation, but we hear very mixed things about the possibility of when a vaccine may come out. So we have to face the fact that Australia is doing pretty well in controlling this, but the economy itself is likely to have some opening up towards the middle of the year, and probably most of the economy open by the end of the year, but probably well into next year before things go back to what we refer to as normal. I think in that situation, people want to know, are we going to be in a recession? Are we going to be in a depression? What's economic growth going to look like? I don't think either of those are particularly helpful. In fact, in years to come, we might have a new term like high recession to call what we've had. And I think the path out of here is going to be, reasonably quick early on, but ultimately quite slow and painful. And by that, I mean the Australian economy is unlikely to return to the sort of activity levels that we saw prior to this for a number of years yet. With that in mind, it's important to remember that demand and supply are both going to face issues as they try to come back on board. And I think on the supply side, importantly, a lot of businesses will come back leaner and trimmer than they were before. And that's going to mean a number of things for jobs and also ultimately for inflation. And from the demand side, of course, a number of workers are unlikely to see their go back to where we were before. Right now, there's 20% less hours being worked across the economy, and unemployment is likely to go up to 10% in the near term, and unlikely to really come back to the levels we saw before the crisis for at least another 3 or 4 years. The Reserve Bank has already told us interest rates are going to be stuck down here for probably at least 3 years, and our view is that it's considerably longer than that. So the way we look at bond markets is they're going to continue to remain very well supported. There is going to be a continuation of the search for yield that we saw beforehand, but from a lower base, obviously. I think people are going to be far more cautious about the sort of credit they keep on. The way the credit cycle works, like the equities, the longer you go, the more upbeat it gets, and it's going to take a lot of time to get back there. So we continue to like being long duration in bond markets across our portfolios. We still have a tendency towards government and the more liquid parts, but we do acknowledge that investment grade credit, the more solid credits, have actually now finally, for the first time in 4 or 5 years, reached what we would call good value. So we're looking to be overweight duration and overweight investment grade credit, but still avoiding a lot of those high yield credits because the default cycle will be running strong for the next year or two.